Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. This quarter, we are diving into Carter's the Kids Clothing Company. Let's see if their financial report is as cute as their baby clothes or if there are any hidden diaper changes ahead. Today we're cracking open Carter's latest 10Q, which is basically their quarterly report card to the Securities and Exchange Commission. We are going to see how they did in the first 3 months of this year from January to the end of March. This report covers everything from sales to potential risks and even some changes in their leadership. So buckle up, let's get started. As of mid-April, Carter's had about 36.4 million shares of their stock out there. This number is important for calculating things like earnings per share, which tells us how profitable the company is for each share of stock. Keep that number in mind as we dive into the financials. Let's jump right into the heart of the report, the financial statements. First, we see the balance sheet, a snapshot of what Carter's owns, which are their assets, and what they owe, their liabilities. Key thing to note here is their cash position. As of the end of March, they had about $320.80 cash and short-term investments. Well, that's a good chunk of change. It's down from the $412.29 million at the end of last year, and also less than the $267.6 million they had the previous year at the same time. This decrease in cash could mean a few things. Maybe they spent more, invested heavily, or perhaps sales weren't as strong. Something to keep an eye on. Another critical line item is inventories, which are the clothes they haven't sold yet. Carter's had about $1,474. Dora's had about $474 a sing on $502.3 million. That is also roughly in line with what they had last year. How efficiently they manage these inventories directly affects their profitability. You don't want to have too much sitting around because fashion changes and it might get old. Now let's look at what Carter's owes. Accounts payable, that's the money they need to pay to their suppliers. Stood at $29 a year, but up from the year before. Changes here often reflect adjustments in how they are managing relationships with those suppliers and inventory purchases. And how they are managing relationships with those suppliers and inventory purchases. Moving on, we need to see how Carter's performed over the last 3 months. We're looking at their income statement, which shows revenues, costs, and ultimately their profit. Net sales were $629, and that's a drop compared to the $600 and of 45 of and after canned and during the same period last year. A decrease in sales is never good news. It tells us there might be issues with demand, competition, or how well they are attracting customers. The gross profit came in at $291, which was also less than last year. Looking at it as a percentage, the gross margin, which is how much profit they make on each dollar of sales after deducting the cost of goods, also decreased a little to 46.2%. Drops in both sales and margins can squeeze profits, so it's a double whammy. They also spent $270.3 million on selling, general and administrative expenses, things like salaries, marketing, and running their stores. This was actually a little higher than the previous year. When your sales go down but your expenses go up, your profits are going to take a hit. All this boils down to a net income or profit of $15.5 million or $0.43 per share. That is way down from the $38 million or 5 cents per share they earned last year. This means that for every share of stock you own, the company earned less than half of what it did last year. It is time to look at the cash flow statement, which tracks the movement of cash both in and out of the company. Starting with net income of $15.5 million as our starting point, it then makes a lot of adjustments. After it accounts for everything, the net cash used in operating activities ends up being negative at about $48.6 million. This means that after all is said and done, their core business activities are using up cash instead of generating it. On the investing side, they spent $13 million, mainly on capital expenditures, which includes things like store improvements. Then on the financing side, it was mostly about dividends they paid out to shareholders. Now, shareholders' equity, which is basically the value of the company owned by shareholders, showed a balance of $847.20. Carter's declared and paid a dividend of $0.80 per share. These dividends are paid to the holders of the company stocks and are a direct cash outflow. Now we have to go through the fine print, which is the notes to the financial statements. These notes give additional detail and explanations about the numbers. They are making most of their money through their direct consumer channels, meaning their own retail stores and website. They are owed a total of $203.09 million. This money represents sales they have already made but haven't yet collected. Carter's has $26.9 million in current contract liabilities, which represents money they have already received for things like gift cards or customer loyalty programs that haven't been used yet. They use a program to help their suppliers get paid faster. There is about $14.3 million in that program. It's worth noting that Carter's doesn't provide any guarantees for this program. Their long-term debt stands at $408.3 million, coming from senior notes due in 2027. It shows they have stable long-term financial obligations. The company didn't buy back any shares this past quarter, but dividends of $0.80 per share were paid to the investors. They are giving their employees stock-based compensation. Stock options and restricted stock awards cost them about $9.8 million. Carter's has an accumulated other comprehensive loss of $43 million. This is largely due to how currency exchange rates affect their international operations. The fair value of the company's senior notes was $495.6 million as of March. This was estimated using a quoted price and conditions, which are therefore within level 2 of the fair value hierarchy. Their effective income tax rate was 27.2% for the past quarter, and they had almost $6 million in unrecognized income tax benefits. The weighted average of shares outstanding was just over 35.3 million, which leads to the basic and diluted earnings per share we talked about earlier. The US still accounts for most of the company's revenue. Most of that goes through wholesale partners. Finally, they say they're involved in some normal lawsuits, but they don't think these will have a big impact on the company. One thing to highlight there is that if consumer sentiment or trade policies changed a lot, they might have to write down the value of some of their assets. Basically, this says that a lot of their value depends on things staying relatively stable. The new management is navigating a very challenging environment, including high inflation and interest rates, uncertainty related to trade policies, especially those introduced by a potential new Trump administration with additional tariffs. To survive that, Carter's is trying to offer better value and more variety in their pricing, trying to make their marketing more effective and working closely with their wholesale partners, basically to offer a good value to consumers because they know everyone's being squeezed right now. They are working on improving their internal processes to become more efficient. They spent $3.2 million this quarter on consulting fees to make that happen, and they expect to spend another $8-10 million for the rest of the year. They are building a strong brand to sell clothing and other accessories for babies and small children. So what's the verdict on Carter's? On the one hand, they are facing strong headwinds, sales are down and profits are way down. They are also facing really stiff competition and economic uncertainty. On the other hand, they are trying to get more efficient, which might pay off down the road, but for now, it looks like they are going to have a road, but for now, it looks like they are going to have a tough year in 2025. Thanks for watching. If you enjoyed this deep dive, please subscribe, like and comment.